oil prices surging more than 4% today on that larger than expected drop in inventories. The move comes as the market gets ready for that all-important OPEC meeting, which kicks off tomorrow in Vienna. The rally providing a boost to energy names, the XLE gaining more than 1% on the day. But even with today's rise, energy remains the worst performing S&P sector this year. Where is the opportunity going into 2020? And Tim, we're going to talk about Aramco a lot more in the next week or so.
I think we will. And the Vienna meeting is often a lot of politics and a lot of theater. But we might get something out of this, which is not just extending the existing cuts, but possibly some lip service enough to say that they could go deeper to support Aramco. I think the most important thing right now is we've gotten to a place where E&P and the energy sector is so oversold on a relative basis that it has to be interesting at some point. If you look at Exxon, look, there's refining tailwinds. There's actually CapEx spend and kind of some of the core profitability of the company is actually improving. I would just point to the fact that the energy sector as a percentage of the S&P weighting is now 4.2%. It was 16.5% 10 years ago. This is a sector left for dead. No one's felt the need to own it. And I think that's
I wonder
overdone.
if that's the death nail. I wonder if that you can't, it doesn't matter. It doesn't move the needle, so no one gets back in. They don't have to represent themselves. The guys that try to imitate all the indices don't even have to be there anymore, so they don't buy it, and everyone are closet indexers anyway. The only thing I see that's worth buying are still the refiners, because the commodity is in a glut supply issue going forward.
Well, I will tell you, beta names, in the derivatives world, and we might have a chart, I don't know, but in the derivatives world right now, the options world, this has been a dominant area for the last 3 days in a row, Carl. So I talked about it just the other day on Monday on the halftime show. It's unbelievable how much paper we are seeing in the energy space right now. Absolutely extraordinary. As a matter of fact, yesterday it was about 50% of the unusual option activity we'd seen was in there. There's been about 11 or 12 different names that have hit, and some of those names have hit multiple times right now. It's unbelievable. So it's beta names, but also some of the names that kind of get forgotten about. Royal Dutch, we don't talk about that very often. British Petroleum, which I know is BP, but the old British Petroleum, another name we don't talk about. We talk about Exxon, we talk about Chevron, we talk about Valero, we talk about some of these names.
But if you look at the XLE,
well.
Carl introed the segment as the underperformer for the year. If you can go back 2 years, go back 3 years, go back 4 years, go back 5 years, the XLE has done nothing. So you've sat there. I agree with the plays, and Tim, you've done this. You've had these trades where you can make a lot of money. They're trading yes. Where you could see a lot of money, and stocks can trade up 30, 40, 50% in 30 days.
Right.
But other than that, I don't know if
and
they're
these beta names move extremely fast. Then when you go to the derivatives side of the world, you get a stock that goes up 5%. Those options are probably going up 30 or 40%. So the derivatives world really gives you the opportunity to get that torque into some of these names.
Look, Schlumberger, we talked about it. Since October, that stock's up 20%. We've been talking about it basically since October. We've talked about this double bottom at $30. Now it's 36 and change. Now you're starting to get analysts upgraded. I think Deutsche Bank in November upgraded at $42 price target. Yes, in the broad scope of things, they've underperformed, but they can still go up another 20% and actually still be relatively cheap. So I think SLB is okay here.
There are fundamentals going on in the oil space that are not terribly sexy, but they're consistent. You've got rig counts up for 15 straight months. You haven't seen that in 5 years. You have a dynamic where you're actually seeing upstream spend is up, high single digits. That is a positive trend. Those feed through to companies that were dead left in the water. So this isn't, first of all, it's not a trade for 10% of your portfolio. This is a trade to be looking at a higher beta name that started to show some life, and that chart actually is a very different chart than it was 6 months ago.
We mentioned Aramco earlier, of course, and we're hours away from getting some pricing on the massive IPO from Saudi Aramco. For that, we're going to turn to Leslie Picker. Hey, Leslie.
Hey, Carl, that's right. Saudi Aramco's IPO could be the biggest in history once we learn those pricing details, surpassing Alibaba's U.S. share sale in 2014. Now, if Aramco prices at the high end of the range, it would raise about $25.6 billion, topping Alibaba's $25 billion raise back in 2014. Now, the order books have now been closed for both institutional and retail investors, which were reportedly met with demand that outpaced supply that's available, but many American and European investors, which would normally take a look at the deal at least, have balked. Aramco canceled its roadshows to market the deal in the two regions, and typical IPO investors I've spoken with have been turned off by several factors, namely the ESG or environmental social governance implications of owning the Saudi Aramco stock. Now, on an environmental front, Aramco is the world's largest oil producer. For example, Singaporean sovereign wealth fund Temasek decided against against investing over environmental concerns. On the social front, the company is controlled by the Saudi government, which has a poor track record on human rights. And when it comes to governance, the Saudi government will continue to hold majority voting power and will also influence the company through regulations. Now, Aramco is also quite expensive, looking to debut at a $1.7 trillion valuation, which is a premium on an enterprise value to EBITDA basis relative to its peers. Those who are buying into the deal, however, are attracted to Aramco's #1 position in oil production globally, as well as the potential for more than $75 billion worth of dividends to be paid out annually, as well as in 2020. Aramco will be listed on the local Saudi exchange, and the shares are expected to begin trading in a week. Carl.
All right, LP, thank you very much for that. Guy, do we think those social issues that she mentions are going to be a real headwind?
Should be, but they won't, unfortunately. I mean, we can play this game, we can play with Facebook, we can play with, across the board, and they should be issues, but if people want to make money. Now, with that said, we're getting to a place in the world where they will be an issue. I think 5 years from now, absolutely we'll be having that conversation. But right now, people will talk about it. But I think if they think they can make money here, they will try.
You know what the biggest takeaway for me is? All of a sudden now, you want to talk about a top in the market, someone ringing a bell. All of a sudden now, they want to give others. They want to give others a shot at this. They want to, and I know it's a percentage of the entire deal. But to me, that's them ringing the bell. If they're telling you that this is the high, then I think you should take their warnings.
If you think about how this is going to trade, where it's going to trade, and who's going to trade it, too, I don't think this is necessarily the kind of a global listing that really makes it a benchmark. And also, as has been pointed out, look, sovereign wealth funds, including the Saudi Arabian sovereign wealth fund, will be a major owner of this. This deal will get bought, but who owns it? And I think, look, you want institutions in there that are very concerned about ESG and governance and control issues. And if they're running for the door, why would you want to follow in after that right now?
Pete, is it large enough to take oxygen away from the broader market?
I don't think so. I think the market is so ready, Carl, that there's always going to be enough around for the rest of the market. But, I think early on people will blame that if we see some reactions in the market, but I don't think that's actually the case.